IUL is preached as this giant of a retirement vehicle where you put money away, it grows tax-free or tax-deferred. But how do I actually access the money? The seemingly obvious response might be, well, like I do from a bank, I log into my account, I withdraw the money, and it's mine. For an IUL, for example, you might log into your policy portal, click a few buttons, maybe sign a form, and there's a check in your mailbox and you withdrew. But is that the wisest thing to do? See, the problem with this whole glorified tax-free thing is when you actually go to withdraw from your insurance policy, decades, years down the road, you can actually only take out everything that you put in tax-free. Everything above that is going to be tax-deferred, like an IRA or a 401k, and you're going to have to pay taxes on that. So you might be thinking, well, what the heck? Everyone told me this grew tax-free, and now I'm going to have to pay taxes on this? That's ridiculous. And if it was described to you that way, that is ridiculous. When people say that not only does your money grow tax-free, but you can actually access it tax-free, take it as tax-free income, however they say, what they're actually referring to is policy loans. Loans, nope, I hate debt, no loans. Bear with me. Here's how it works. There's two ways. First is fixed loans. A lot of times people will call them zero wash loans. Now what this means, a zero wash loan, for example, is let's say you had money in an account, you have the $1 million, and you would like to access 100,000. What they'll do in a fixed or zero wash loan is they'll say, okay, we're gonna loan this 100,000 out to you at 2%. But we're also gonna guarantee that we're gonna put that same 100,000 in an account that's gaining 2%. So even though we're charging year 2, it's also gaining 2. So it's basically a wash, it's just taking money out tax-free. Now, a lot of people will do that. Sometimes that's a great option. It is important to note though, that in the beginning years on a lot of companies, they're not gonna offer these. Sometimes they'll offer a fixed loan, but it'll be let's say you're loaning at 2%, but they're only gonna credit you 1.5. Or you're loaning at 2.3, but they're gonna credit you 2. So you actually pay a little bit. The other, and the second, which I think is the wiser way, is variable loans. I've explained these briefly in other videos, but essentially what a variable loan is, I'm gonna go back to the $1 million example. Let's say you loan the 100,000. You loan it out at a variable rate. Obviously variable means changing, but it has a cap. So let's say it's 5%. I'm gonna loan out $100,000 at a cap of 5% rate, but it is variable, so it could fluctuate. Let's just assume it stays at 5. When your money is being loaned out at 5 over here, what they're doing is they're saying, all right, we're gonna give you that 100,000 at 5, but we're still gonna link that 100,000 to the index. So if the market does 10, you get the full 10% on that 100,000, even though you've already took it and spent it and it's done with. But you still paid us 5. So you gained 10, you paid 5, you just gained 5% on money that you've already spent. Now, what if it gained 7? You paid 5, you gained 2% on money you'd already spent. Now here's the danger. What if it lost? Well, you gained 0% on money you already spent, but you still paid 5. That's the danger of it. A lot of people don't always talk about that. It's not always gain a spread of 2% every year, just like anything does not average a certain percentage every year. In summary though, you can withdraw up to the amount you put in, tax first in, first out, tax free. After that, anything else you withdraw is fine. You can still withdraw, but it's gonna be taxed. You can do policy loans. There's fixed. Some people call them zero wash, to where you loan out at 2 and gain 2, but they aren't always offered. Then there's variable, which I think are typically the smartest because they're capped. Let's say it's capped at 5, you can still gain a spread on money you've already spent. So when people say, how can I withdraw money from my policy? I usually would say, hey, I can show you how to do that, but there might be a smarter way to actually access that money than just withdrawing. Now, if you're starting to think, all right, I'm kind of starting to understand this whole IUL thing, but is it even for me? Who is an ideal client for this whole thing? That is what I'm going to go over in my next video. Make sure to subscribe, and I will see you there.